Welcome to Front Range Facts. This is Anthony Meisner.
And this is Jim Merrion. We've got our special guest here today.
I'm David Cox from Cherry Creek Mortgage. Thanks for having me today, guys.
Absolutely. Well, we wanted to just start things off talking a little bit about the national picture like we normally do. And a company called Altos Research, which does a lot of research in the real estate industry, has really essentially, expressed, complete surprise that there are no signs essentially of the market slowing down in any of the data. And that's essentially what we've been coming to the conclusion the last few months too, is this market is continuing to heat up in ways that are mind-boggling, but really have a lot of reason and thought behind why it's happening.
That's right. The reason we really brought David on today was to have some of that insight on the interest rates and just how that's going to affect the market. And so we wanted to start with our big wow moment, right? Like, here are the last 5 times where interest rates are in a rising market, really, and how that affects the market as a whole and what's happening to real estate prices during that time frame. So, David, what are we looking at here?
So on this slide here, we've got some different time frames that are showing up, and the rise in interest rates over anywhere from 8 months all the way out to a little over a year and a half. And what corresponds to that is that home prices still continue to rise even though the interest rates were rising as well. Home sales were down a little bit in each of these time frames, but the big picture I think that we're trying to drive home is that it's not a bubble. We're not going to see home prices decline. We may see the appreciation, the historic appreciation that we've experienced recently, taper off a little bit, but home prices are still expected to rise.
Yeah, I think the one thing that's happening when an interest rate environment is a rising environment is you're actually pulling buyers out of the marketplace, right? So it doesn't necessarily affect the supply line as much. The supply line takes a longer time to be affected. So that's why you still see that appreciation rate, even though home sales start to slow, right? And home sales start to slow because they become less and less buyers in the marketplace as interest rates rise. So you can see here, some of these periods took 8 months, some of them took 19 months in order to reach some of these big swings in interest rates. The big difference here that we'll talk about is how fast this is happening.
Yeah, the rise in rates that we've seen here over the last about 4 months is outside of what we've seen in the past.
And even in that 19-month period where the rates went up almost 2%, the prices went up 13%. Mm-hmm. So our point here is there's no correlation in any historic market as to interest rates going up and prices going down. In fact, it's quite the opposite, which bellies reason a little bit. It's the exact opposite of what a lot of people have been asking me about when they talk to me and say, well, prices are going down because interest rates are going up. It doesn't happen that way.
That's right. So let's dive into this a little bit more. Existing home sales across the United States, there's a lot of places where they've been stifled just a little bit, right? The national average is down 2.5%. A lot of that's due to interest rates and shortage of inventory in many places. The one place that's actually up is in the South.
It's the inventory. That's essentially.
That is where the inventory is, right? That there's the availability.
They've got all the new builds in the South. They're able to bust more inventory out, but everywhere else is suffering.
That's right. So what about the new home sale market?
Well, this is what I think is kind of interesting is when we talk here at Front Range Facts, we're a Colorado show. We talk Colorado market. We also touch on the national, but we're a bit of a bubble, right? Because the average sale price in the Denver metro area is $740,000 right now. So those last two numbers there, the ones that's 500 to 749 and then over 750, that's essentially most of our market here in Colorado.
Right.
So that distribution just doesn't really work right here. So if you were to look at ours, it'd be quite a bit different. But nationally, just to put this in perspective, nationally, only 10% of homes sell for over $750,000 when that's essentially the average sale price here in Colorado. So we're at a great difference between what you hear on national news and the trends there versus our local little pond here in Colorado. So Don't believe what you hear always about the national stuff affecting us.
Another huge point of this here is what leads to a distressed market, right? So what leads to those type of bubbles? Well, I mean, this is from years and years ago, but you can see just how over time with the shortage of inventory in the United States, less and less homes become distressed because more and more people are putting money back into their properties. We're building new properties, and that's really, with that housing shortage creation, it just goes to show you, how much more effective the active inventory in the market really is.
Yeah, I mean, there's a lot of differences. If you go all the way back to 2008 and the just the historic foreclosures that we saw at that time, they didn't have as much equity as we've built here recently.
Right.
But yeah, that trend is flatlined for sure nationally.
Yeah,
it's always
less than 1% nationally.
It's been very flatlined here in Colorado for quite a while.
Yep. All right, so what about this one? Percentage change in sales.
So, here we have basically, quite a bit of a market breakdown across different price points where, instead of just hearing about, hey, prices have gone up nationally by X amount, we wanted to show you a little bit about, where those price swings are happening in different price points. So even in the above $1 million price point, you're getting a 21.2% increase in prices. You're getting a 24.1% increase in that 750 to $1 million price point. And essentially the lower end of the market, the reason why you're not seeing much there is because there isn't much for sale at all. Where can you buy something under $100,000? I mean, this is the United States. It's,
yeah, not here. Exactly.
So obviously that left side of that orange part of the graph is down.
Just with less data, right?
Yes.
The numbers are going to be skewed.
Yeah.
Exactly.
So change in home prices year over year, this starts basically a 10-year picture of time, right? And so, you saw a dramatic increase once we got out of the recession. About summer 2012 was when really things started to take off. And you can see that, we started puttering around then after we, got over that initial exuberance. Then when COVID hit, where that hill starts to climb again, you just see this rapid appreciation and escalation in prices. And it's kind of with us for the long run now with the trends.
Yeah, it definitely seems that way. All right, so the months of inventory with home sales really correlates to those price appreciation numbers, right? So as we have less and less inventory, you're going to see more and more price appreciation. So here we are from 2011 to current, and we had 8-9 months of inventory in the United States back then, and all the way till now where we are at sub 2 months of inventory for the entire nation. So with that comes that price appreciation, right? Because people are willing to pay more. Homes are turning over so much faster, and it really creates and breeds that market condition.
Unfortunately, it's probably going to be something, as far as the lack of supply, with the builders not producing enough of new home sales. Right. This is something that's going to, continue to hurt the supply for many years to come.
Absolutely. Well, I'm Anthony Meisner from Land Title. We have a lot more to come, so hang in there with us. You can reach me on my cell phone if you have any questions, 303-968-9868, or on my email at ameisner@ltgc.com.
And I'm Jim Merrion, Realtor here at Coldwell Banker. Phone number 303-548-0243, and you can always shoot me an email at jim@ourcoloradohomes.com.
And I'm David Cox from Cherry Creek Mortgage. I've been lending here in Colorado for about 20 years now. So if you have any questions or mortgage needs, don't hesitate to reach out to me. My cell phone number is 303-903-9065.
All right, let's get back to the good stuff. Jim, what's happening here?
Well, this is, touching upon David's point about the new construction drop, right? I mean, exactly. It's this whole, gun-shy kind of mentality the builders have had. That line that's going across there is the average units completed annually, kind of long-term historic trend. And as you can see, just for the last 12 years now, from 2010 to now, 14 years, we are below that 50-year average mark significantly. I mean, we have this giant trough that the builders have developed over the last 14 years that are going to take, we estimate, looking at national economic data, not us estimating it, but people who are actually smart about economics, are estimating it's going to take 13 years of 1.5 million new homes being built a year to build us out of that trough. So there's no magic bullet on the horizon. That's why this is going to continue to be a very challenging market to be a buyer, and why it's going to be a very beneficial market for sellers long term.
Well, and I think the big part of this too is where is that inventory being built? Because it's got to be built where people want to live. And since there's these net migrations to city centers and to different parts of the country than we've traditionally lived in the past, some housing units that are on the market are also going to become obsolete in that process. So it's really creating this huge void. And we made it so much worse from 08 to current, right? Yeah. I mean, builders got so gun shy because they got burned so bad during the Great Recession that it's taken them basically until current to keep up with current demand, let alone backfill everything that we've dealt with.
Absolutely. And this is again, another piece of that puzzle where the inventory levels, have just, that line you see there is that 50-year median of inventory levels. And if you're above the line, you're above average, you're above the median. If you're below it, you're doing bad with your inventory levels. And as you can see, the trend line over the last few years has been abysmal, and it was preceded by a rough spot as well. And so that deficit is built up by not only the builders, but then also the fact that there hasn't been as many people that have been living in their home longer. And now that 95% of the market of homeowners has an interest rate below today's rate, we're probably not going to have a lot of people selling over the next few years either.
I think the underlying theme may be though that real estate continues to be an incredible way to build wealth. If you are so lucky to get into the housing market, you're going to be on the lucky side of some of the appreciation that we've experienced recently and the projection going forward.
Absolutely. Well, so where are buyers? It looks like they're everywhere.
So this is from Showing Time and National Association of Realtors data, and basically, as you can see, if it was a very faint line, it'd be a very weak amount of buyer traffic. There's nowhere in the country that's doing that. Most of the country is in that very stable or strong, for the most part, market. So we've got more people in the strong buyer traffic, a few states that are showing a little bit of weakness with the buyer traffic. So it's not like it's a Colorado story with this housing market. This is a national story of the market as a whole being very robust in most places that you look. And on the inverse side of that, then, this is not essentially seller traffic, but it's the seller inventory. Looking again at kind of a 50-year median historic numbers, that very faint part in a lot of parts of the northern parts of the country are very weak. It's considered extremely weak, very inventory light, and there's only a few places in the country where it's actually considered essentially strong, right? You've got Arizona.
Or even stable, right?
Stable, sorry,
not even strong.
Not even
Not
strong.
even close to strong.
Yeah, it's stable in 4 states, right?
That's right.
And it's either weak or very weak in 46 other states.
Yeah.
So
that does make it very difficult to move right now.
Yeah. So with rates rising and expected to rise through 2023, we are seeing, of course, that counter to inflation with the rising interest rates. It does make a lot of sense, obviously, to get in on purchasing now, or if you're one of that few percent of people that has not changed your mortgage, to be more palatable, get in now before they continue to go up.
And mortgage rates are cyclical. So even though we've seen a significant increase in rates, as this slide shows here, this goes up. It's not all the way up to date for current day, but this shows the significant rise in 30-year fixed rates that from the historic lows that we saw over the last couple of years. Real estate is still an incredible opportunity, and as rates rise, they will come back down in the future. The expectation is that we may see rates go up into the 6s, potentially by the end of this year. But with some of the discussion around recession and what may take place in the coming months or years, rates will drop again. So if you can get into the housing market, capture some of the appreciation, the interest rate may not be ideal for the initial mortgage, but there's going to be an opportunity at some point in the future for you to improve that and lower your housing.
And I think the other thing that the slide really helps to illustrate is interest rates have gone up dramatically over the last couple months. We've all seen that happen. But historically, it's more getting into that moderation, right? Because 6% is the historic average essentially for interest rates. And so we're still in a pretty good spot as far as historic is concerned.
Yeah, so one of the things we wanted to talk a little bit about was just how fast they're rising right now and kind of expected to continue, right? So
yeah, rates have rose, over 2% since the beginning of the year. We were under 3% in late 2021, kind of in that November, December timeframe. This chart here kicks off at the very end of December, and it goes through, it looks like the end of March. Here recently, we've actually gone just a little bit over 5%. But like Jim said, it's still within the kind of the average range. But people, had been spoiled with the rates that were down, in the 2s or 3s, and it's possible that we may get back down into the 4s or the 3s, at some point over the next 4 to 5 years. But it's still affordable, for looking at a bigger picture.
Yeah, so here's your 1-year view, right? So we were really kind of sitting in the 3s during 2021, really consistently.
Yeah, hovering right above or right below the 3% for a 30-year fixed, and then as you can see on the far right of the chart, the different sources there are showing rates being over 5%, and keeping in mind too that those rates assume that you're paying some amount of discount points, typically somewhere between 1/2 and 3/4 of a discount point to buy it down to the low 5s. And the expectation is that we will see first mortgage rates continue to rise as we go throughout the year. So this chart here is the 10-year U.S. Treasury. I've put a couple of lines for the most recent weeks here. Wanted to kind of talk just real briefly on this, that it's hard to break out of a very defined trend, and this is definitely a very defined trend. So the expectation for the 10-year to climb, which will once again drive first mortgage rates up, is likely to continue. There's going to have to be something, some big economic factor to change the direction of where mortgage rates are going.
And I think it's just important to explain to people who may not know, the 10-year treasury is what you always hear about when you say the feds are raising interest rates, and then there's a lot of correlation with then 30-year mortgages, and other loan products, correlating to that rise as well. Correct?
Yep. Yeah. And then the federal funds rate is expected to climb quite significantly this year, which will have a direct impact on certain types of financing, that being home equity lines of credit, auto loans, credit cards. There is an indirect impact as far as what the feds do with the federal funds rate to first mortgage rates.
Right. It's more of a lagging situation,
Correct.
right?
Yeah. So essentially, it's not a prediction. It's pretty well understood that interest rates are going to continue to rise. We have an 8% inflation rate, right?
Mm-hmm.
And how do we combat that? Well, the number one tool is to raise interest rates. So it shouldn't be much of a surprise to anybody who pays any attention to the news that this trend is going to continue. It backs up what David was just saying with that trend line. And you should continue to see that monetary policy get a little more aggressive with how they do those implementations.
Yeah, I mean, they have to get inflation under control because it is at an extreme rate right now, and so they're going to be manipulating the markets to try to keep that heading in the upward direction and hopefully going back down.
All right, so what about this one, David? This is right out of your stuff you guys send to your clients.
Yeah, this is an everyday conversation that I have with buyers. It doesn't matter if you're a first-time home buyer or if you've owned several homes in the past. It can be very discouraging, and I'm sure you're seeing that on your side. With how competitive the market is, there are certain buyers that are afraid to be aggressive on their offer price, or maybe they've lost out on multiple offers and they just want to put the home search on a pause for a little bit. And so there's an important conversation to be had, and that's the cost of waiting. With the expectation that home prices are going to continue to appreciate, maybe not at the double-digit appreciation annual rates that we've seen recently, but they're still expected to appreciate at an above-average pace. First mortgage rates are going to be increasing. So this is a slide here, lots of different numbers on here, but I think this shows, if you're looking at that $1 million property, potentially here in Boulder County, putting 20% down, there is a significant dollar amount for cost of waiting. When you start looking at the rise in interest rates, even over just a 6-month period, you're looking at almost $50,000 between the higher purchase price, the larger down payment, and then also the potential for the rise in interest rates. Just a quick note here, the rates quoted on here are for jumbo rates. We've seen a little bit of a flip from what we've seen recently, where jumbo rates are actually below that of a conforming loan amount. So the higher priced homes are actually benefiting from a little bit lower than the conforming interest rates. You go out over a 2-year period, you're looking at about $168,000 more that you pay just with the different factors that this slide is presenting.
This is like such a huge slide. I think like anyone watching this, should spend a few minutes just staring at the different numbers on this, because this isn't just like a hypothetical. It's something like David, I, and Anthony have seen, every year, where there are like clients that decide not to buy. I had a couple people who got gun shy during the whole COVID thing. Most of them stuck with it, but I look back at those folks and go like, God, they're hurting so bad now because they never pulled the trigger on it. They haven't made that move, and that cost of waiting isn't something that ever goes away.
No, it keeps getting more extreme, right? So you miss out on $168,000 worth of equity essentially in 2 years. But the other part of that is it makes it so much more difficult to qualify 2 years from now, because now what's the chance your income's going to go up to offset?
You're chasing a target that's
20% increase in real estate price.
You could literally, if you wait a year, you could have just bought a home, sold it a year later, and still come out better than if you had waited. So you would have zero risk of mistake as long as you didn't destroy your home in the meantime, and you would still be better off. So if you're indecisive, just buy something and then figure it all out later on. You've got all this instant equity you built up then over that year or 2 years that you said, you know what, this isn't perfect, but it's good enough.
Exactly, and I think a lot of the first-time home buyers missed the boat on that, where they're like, well, I'm not really sure if I want to continue to live in this area for more than a couple of years.
That's key.
Doesn't really matter.
Yeah,
You're going to miss out on $170,000.
Yeah, that whole adage of, don't let perfect, or don't let good enough be the enemy of perfect,
Exactly.
kind of thing. It's totally at play.
Well, and I think too, if the house is not perfect, that's okay. It can be the right house for right now. And if you wanted to change, whether you want to move to a different city or if you wanted to, a house in a different area, there's still going to be opportunity at some point in the future, because you have that substantial amount of equity that you built.
Well, in 3 years, you've got 237,000 more than you had, prior to that. So
that's a lot.
That
And
could be a couple bucks to work with.
These are probably pretty conservative estimates, or you wouldn't be putting them out there too. So.
They are, yeah. I mean, the appreciation rates that are built in here, are not going to be as aggressive as what we potentially could see.
Or what we have seen. Right?
Exactly right.
That's the real problem is
Yep.
some homeowners have seen their house double in value in 3 years, in the last 3 years, because it's been a very extreme market. There are times when that's going to take place. There are times, especially like what might be coming down the pike for us, where it might be a little bit more limited. But either way, I mean, when you look at these numbers, I think this is pretty much a no-brainer.
Absolutely.
So,
Yes.
this kind of, plays into this slide, right, David? I mean, just hedging against inflation, let's talk about this for a minute here. We've got, the blue line is obviously the inflation rate and the green line is home appreciation. And look at that. Every single market basically we're in, home appreciation is higher than inflation rate.
The craziest part about this is even look at the 80s when we had stagflation,
Yeah.
right? 5.6% increase in inflation rate and 5.5% increase in housing rates. Like, that was the best bet was in real estate at that time. And who would have known? You're paying like 16% interest rate for a loan at one point, right?
Yeah.
I mean, even in the worst possible scenario, that was still the best
So
bet.
on a national level, you fight inflation by playing with interest rates.
Yeah.
On a personal level, you buy real estate.
You buy real estate. Exactly, and that's really what we've seen in a lot of the markets is you really see those investors coming hard to market over the last year or so. I mean, I think I read some national statistic about 20% of real estate purchased last year was by investors.
Wow.
So it's a really, really big number.
So let's double this, folks. This is a national slide, but let's, kind of compare this to Colorado, right? So in 2022, the average national price for a home is about $360,000. Nicely, we have Colorado essentially double that at $740,000. So, let's just, put a double, number on each of these things for appreciation. So, what this shows is in the next 5 years, the appreciation projected by this home appreciation survey of economists is essentially $96,000 nationally. So it's going to be about $200,000 in Colorado based upon our average sale price.
Yeah, and I mean, when you start thinking about growing your overall wealth, I mean, $200,000. I mean, you're not able to. Most people, the majority of the U.S. is not able to save that much.
Yeah.
They're not getting
close, right?
They're not getting that much in an income bump. So real estate continues to be an incredible way to grow your wealth, and it's just a matter of getting in as soon as you can with the right home.
Well, I mean, you and I did a presentation a few years ago, David, where the average renter has something like $5,000 in savings.
In net worth.
In net worth, right?
Yeah.
And then the average homeowner over the next 5 years is going to gain $200,000. So what are you waiting for? Buy a home.
That's exactly right. And look at this. This is home price forecast by all the major data providers and all the major people that kind of weigh in on what's happening across the country. And even if we look at the average of all 7 of them, we're still expecting during 2022 nationally to get almost a 7% increase.
This leaves out 2 big players, though, too, in this slide.
It does.
Goldman Sachs predicted a 16% increase in prices, and Zillow predicted a 13.6%. I mean, I got to tell you, like every year I see NAR and CoreLogic put out numbers. It's always so conservative and it's always so off.
So conservative.
NAR I think in 2021 is predicting a 3.6% increase or something like that. So the point here, folks, is that we're showing you very conservative projections for 2022, and I kid you not, we're at least at HPES's right now just for 2022, and we're only at the end of April. So we're at about 9%.
Yeah, here in Colorado, I'd be shocked if we didn't get the 9.6% appreciation already this year.
Yeah.
Right, because of the bidding wars and because of everything else that's going on here. Chances are you could see 20% appreciation by summertime in this market.
It's so common to see a $700,000 home sell for $800.
Yeah. I mean, the Colorado market is out of control.
Yeah. So who are we?
Well, I'm Anthony with Land Title. You can always reach me on my cell at 303-968-9868 or my email at ameisner@ltgc.com.
And I'm Jim Merrion, Realtor here at Coldwell Banker. My phone number is 303-548-0243, and I'm at jim@ourcoloradohomes.com.
And I'm David Cox from Cherry Creek Mortgage. My telephone number for any sort of mortgage questions or mortgage needs, or if you just want to talk mortgages, my telephone number is 303-302-3839.
And he likes to talk about other things occasionally too.
Yeah, I enjoy talking about mortgage and real estate. It's a passion of mine.
This one should be on here, so.
Oh, you don't want to talk
Yes.
about that? All right.
I don't want to talk
Well,
about
let's
that.
go into Boulder County.
Yes.
So our normal format, we go from national to state to local, but we're going to skip the state stuff because it's really in line with a lot of what the local stuff is dealing with. And we have David here, so of course, celebrity guest.
Wow,
David.
thank you.
Yeah, we got to stick to his neck of the woods, right? So we're going to stick to Boulder County today. This is some data that we put out at Land Title, and I just wanted to kind of articulate really what we've been talking about all day, from what happened in the last recession to current, and just how extremely different these scenarios are. Just another way to talk about how we're not in a bubble, but also really just to help show, where we're at and where we're going, and
Well, I'm sure
how long it's going to take to really shift the market we're in now.
you guys are probably having the same types of conversations that I am, where buyers may be hesitant to jump into the market because they are somehow relating where we're at right now to 2008, and it's completely different.
God, yeah.
Completely different.
Yeah.
And so some of these slides here I think are going to kind of further support that.
Yeah, I think the real problem is the last recession we had. That's the one people are looking at. Well, fortunately for us in America, we had the largest length of growth that we've ever had in the country. We had 12 straight years of stellar growth, right? And then we fall into a recession. So here we are talking recession. It still could be a ways out. It's hard to say, how quickly we can reel in that inflation, right? But either way, the real estate market does not react on a dime like maybe an interest rate that spikes quickly. Right?
And I think too, the thing that people don't get is because A, memory's short, and B, most home buyers are 40s and younger. For the most part, the millennials are the big, huge cohort right now. Almost every recession, in fact, every recession except for 2008, real estate does not correlate to that. In fact, it moves opposite of that. So recessions, the economy goes down, real estate goes up. The only time it didn't was when we did a self-inflicted wound on the industry in 2008.
Real estate.
Yes.
Yeah, exactly. Okay, so here's kind of the biggest takeaways here. This is average sales price of single-family homes in Boulder County. So currently we're sitting at about 1.2 million, right? And you can see 12 years ago or so, when we were at 2009, 10, 11, really just where prices were sitting and where they really they weren't changing much, right? During that time period, they stayed pretty flat. And the median did the same thing. Here we are in this environment where buyer demand is so high. We have no inventory and it's just skyrocketing. So enough to be said about that one. The condo market, very similar situation this time. We're seeing increases in the condo market. Back then we didn't. We really saw everything stay pretty flat and pretty level. Here's the real situation though, is that supply and demand, right? We're talking basic economics 101. The real estate industry supply line shifts very slowly. The demand line also shifts pretty slowly, even with interest rates like they are today, right? We're starting to see that in the data, but what's happening here? This is active units on the market, right? So the top three lines would be our 2009, 2010, 2011 numbers. And there's a lot of inventory, right? But it didn't shift very much, right? Every year we just kind of chipped away at all that, foreclosures that were coming on the market and everything else. And here we are, but our active units are, as low as we've ever seen them in Boulder County, and they're still declining. We're going into a spring market where they're bumping up a little bit because of some seasonality. But the reason for the seasonality is in a really healthy real estate market, you see a lot of seasonality. So you look at the new listings, this is new homes coming to market. We're still on our trend we've been for 3 straight years of just booming listings coming, right? But the difference between where we are today with no inventory and before is all we feel is the new inventory, right? We don't feel anything that was on the market. So back then,
It doesn't exist.
it was nice and flat because you could pick and choose whenever you wanted to buy a house, right? When's most convenient for you to buy a house? Well, that was when you bought a house back in 2011,
Yeah.
right? Now, you buy houses when they're available. And so you really see this surge, within hours of it coming on the market. And that really is going to happen this year from March through October.
I booked a showing yesterday for one in Cherry Creek Village that was 3.3 million, and they started showings yesterday. When I booked the showing, there was none available for yesterday, and so I had it booked for Saturday. Well, they went under contract about 8 hours after they went on the market.
Oh,
of course they did.
Yeah.
Yeah, so that's the supply side. Now, if we look at the demand side, this is the buyer side. This is what I'm talking about, how strong buyer demand is right now. If you look at the month supply of inventory, that's is kind of a longer term view of how heavy the demand is on this. And here in 2022, we're at the very bottom of the chart, right? It does not get faster than where we're at, right?
Mm-hmm.
We've saw it a little bit faster in February than March, but in all reality, we're way past where we were in the peak of the market last year, which Jim and I were telling you is like, might be the greatest market of our lifetime, right? For a seller, this is amazing. And you can see that was at 8 months at the peak of the recession, even more, maybe closer to 10 months during the summertime in 2011 when all those foreclosures came on the market. The pendings, this is like active, but people putting houses under contract, nice and flat, really low back in the recession eras. And here we are still with the only thing limiting the number of pendings right now is those new units coming on the market. So we're still in a very seasonal swing. We're going into our spring market. We have plenty more coming through the summer. So yet again, completely opposite markets of what we saw back in the recession eras. The other thing is speed of the market slows down quite a bit when you're in this, right? When you're in the middle of a recession 2011, I mean, people were waiting 100 days to put something under contract, right? You could go shopping for as long as you want till they found the perfect house or whatever it is that they did back in the day, right? Now it's 15 days on market, which is faster than May of last year, which is generally, the fastest month.
And I mean, look at, Anthony, move your mouse over to that pink line that goes up like a rocket right there.
This one?
Yeah. So, that is the percent of over asking price, basically. We're at 107.5% right now.
Right.
And just look at how fast that took off compared to other years.
Well, and this is unheard of, right? In all of the data and recorded history, you didn't see anything like 2021, and here we are in 2022 where it's more extreme.
Yeah.
Which, I mean, I didn't see that coming. There's just no way to see that rising interest rate markets, all of this other stuff, but there's still so much demand out there, we can't even seem to taper that off. Yeah, it's pretty incredible.
All right, well, again, I'm Jim Merrion with Coldwell Banker, Realtor here at 303-548-0243, and I'm Jim at ourcoloradohomes.com.
I'm Anthony Meisner with Land Title. My cell phone's 303-968-9868, or you can get me at aameisner@ltgc.com.
And I'm David Cox with Cherry Creek Mortgage. We've obviously talked a lot about how competitive the market is. If you have any questions, you want to learn about how you can be successful in the current market from the lending side, please don't hesitate to reach out. My number is 303-302-3839.
Don't forget, if you want to reach out to the show, frontrangefacts@gmail.com. We're happy to share our slide deck or any other local information. You can always check out our other podcast that Jim and I do, Get Real with Blockchain, anywhere where you get your podcasts.
We'll be speaking at the Summit County Realtor Association in the beginning of June as well, so if you'd like to check us out, speaking to a group of people over there, well, you can see what you can do to make it happen.
Absolutely. Jim and I are hitting the road.
So yeah, we wanted to thank our special guest, our celebrity guest, as Anthony would say.
I love it.
And David Cox and Cherry Creek Mortgage. So feel free to give any of us a holler if you have any questions about the real estate. But thanks again for all your time today, and thanks for the insights on it. And hope you guys learned a little bit.
Thanks for having me.
Bye, everyone.